Hi everyone. Today we're going to be looking at the Robert-Shiller CAPE ratio. And more importantly, we're going to compare the CAPE ratio to forward earnings. First thing I like to do is look at the Yale website where Robert Shiller posts his data. From here we can download the data in raw form and work with it in Excel. Notice here that I have date, CAPE, and the S&P 500. The downloadable file has a lot more information. I've slimmed this down for easier use. From this data, we're going to calculate forward returns at 1 year, 5 year, 10 year, all the way through 40 year intervals. We're going to use the CAPE ratio as an indicator of what forward returns will be from the S&P 500 excluding dividends. From this data, we can look at the CAPE ratio and the future returns expected from those CAPE ratios historically. Notice the linear line of fit goes right through the middle of the cluster. While the residuals aren't super tight, I can at least agree that directionally that the CAPE ratio would be indicative of future returns given a 40-year hold in this example. To further illustrate the 1 year through 40-year holds, let's look at a table. Notice on the left-hand column that the CAPE ratio ranges from 8 to 40. That was the widest range I could see over time to where there would be enough data to make a general consensus. And then further, there's a 5-year to 40-year hold. And notice that the heat map blends to the top right-hand corner is most favorable, the bottom left-hand corner is least favorable. That would indicate the more expensive it is based on the last 10 years of annualized inflation-adjusted earnings, the harder it is to achieve future returns. That makes sense. The cheaper you buy it, the easier it is to have forward returns that are greater or at least average. Let's look at this in the line chart. This is from longtermtrends.net. I find their information very useful without a lot of excess clutter and the graphics to be very appealing, and I use it as a reference for macroeconomics. But if you notice right here, we're at a CAPE ratio of around 28 or 29. This is second to the 2000 tech bubble and at or even sometimes above the 1929 stock market crash. There should be reason for concern. Valuations are extremely expensive in relationship to their historic mean. Let's compare this back to the table. If we look at the table and notice the blue star that we have here, that indicates roughly where we are in the CAPE ratio on an average of the last few months. Notice that on a 5-year hold, assuming that history repeats itself, we would have roughly a negative or 1% return on average. We would have to hold nearly 35 or 40 years to approach a reasonable, in my opinion, return of 5 or 4%. If you notice back at the chart on long-term trends, that there's only been one time in the last 12 years where the Shiller PE ratio was in quote-unquote fair value. So in that range, at 14 PE, let's compare what our future returns may be. On a 5-year hold, it would be around 7%, and a 35-year hold would be around 6%, 7%. But the nice thing about equities is if you have a long enough time frame to recover from, let's say, a bad quote-unquote purchase, or a purchase that was too expensive and you didn't meet your return requirements, time can fix most mistakes. And what do I mean by that? Let's say, for example, you consistently dollar cost averaged into the market, and your CAPE ratio average would have been around 17 or 18. Well, notice that those are very similar here. But let's say that you had dumped a lot of money into the market in one static pool. You'll need to hold for a significant amount of time. But over time, you still do approach the mean. Let's look at this from another perspective. On the top here, we've taken 1 year through 40 years, included the average, and measured the standard deviation by hold. Now keep in mind this isn't for any particular CAPE ratio, but more the average of all of them, which is around 17 or 18 in this example. And the first measure that we have is plus and minus 2 standard deviations. This is what we call a 95% confidence interval. That means the mean minus 2 standard deviations, and then the mean plus 2 standard deviations, and ran those out by the length of hold. Let's look at the chart here for further illustration. Notice over time the deviations become smaller and approach the mean. This gives us a higher degree of confidence that if we're to invest for the long run, that we're probably going to be close or at, or even sometimes above, our objective. Let's look at 1 year, for example, here. On average, 5.68% if you were to hold an equity for 1 year. But let's look at, let's say, March through current, around June of 2020. We've had a run-up of 35 to 40% in the market. Conversely, around February, the market declined around 35%. This foots back to the data. I believe that some retail investors do not really look at the returns as a percentage on a compounded basis, but rather as a total percent of return. And I don't believe they're going to get too hung up 30 years from now whether their multiple of what they invested was 4.5 times or 5 times or 6 times. They're just going to be happy that it grew over time. And I believe for most of them, they just need to put the funds in the market, be patient, don't go in and out of strategies, and just hold for the long term because it can cover up some mistakes on the front end. If you like the content, please like and subscribe. Make sure to turn on the notifications. Thank you so much.